Hi, I'm Sue Frano with the Breglia team at William Raveis Real Estate, and today I'm with my favorite loan officer, Joe Mollica from Raveis. Hi, Joe.
Hi, Sue. How are you today?
I'm so good. How you doing?
I'm great. Thank you for having me.
Thanks for doing this with me again. I love it when we get together.
Yes, me too.
We inform people of a lot of good news, and today we have some.
Yeah.
Today I have buyers, and they are a little leery about the way the market's gone, and I was just wondering if you could tell us what could benefit them, what programs you have that could benefit them in this market.
Yes, so there is a lot of discussion with buyers about alternative programs that could be of benefit in the current market. The discussion that I have with a lot of buyers is that we are likely going to see interest rates come down in the next year to 2 years, so that they may want to just look at a type of loan program that buys them some time to get to that point. So, and in doing so, what we usually will talk about is adjustable rate mortgages. Obviously, those have discounted interest rates for a period of time. It could be 5 years, 7 years, or 10 years, and which are very stable programs. We talked about the possibility of buying down the rate with points, paying a little bit of points to get the rate down a little bit.
When you say points, what does that mean? Because I think a lot of people they're not sure.
So points is a way to buy down the interest rate, of course, and reduce the mortgage payment. And it's a percentage of the loan amount.
Okay.
So 1 point on a $100,000 mortgage would be $1,000, and it'd be payable at the time of closing, and essentially purchasing a lower interest rate in doing so. So it's a one-time
That's a great option.
It is, and sometimes what we try to do is keep points at a minimum. We want to keep those low if we can, and see how much value we're getting in the interest rate, and we talk about paying points. Another great option is temporary buy downs. So this is a loan program where the interest rate will be reduced. So a 2-1 buy down, for example, will reduce the rate by 2 percentage points.
Yeah.
So if the rate was 7%, in year 1, the rate would be 5%. And then in year 2, it would be 6%. So it's called a 2-1 buy down. And it's generally a great way for borrowers to keep their mortgage payment lower. So just as an example, on a $450,000 mortgage, a 2% reduction in that payment is worth about $560 a month. So for that first year, they can save that much. And in year 2, it's about a $260 a month savings before the rate goes to the actual note rate.
And you had talked about adjustable rate in the very beginning. What can you save there?
A similar amount. It really depends on the loan program, but usually those loans are going to offer discounted rates enough to make it, make sense for a borrower to take on the risk of having the adjustable loan. So, but the buy down is great because it's predictable. Yeah. It's not that you're going to be in an adjustment period. It's just, this is what it is in year 1, this is what it is in year 2, and then in year 3 you are at the normal rate. And the likelihood is that you'll have an opportunity to refinance that loan and, essentially take advantage of the lower payments and get out of the loan program before once rates come down and you have the opportunity to refinance.
It's nice to know you think that they're going to too. So we have 3 really good options.
Yeah.
Points, buy down, adjustable rate.
Yes, and I'm happy to discuss those, of course, in more detail.
Give Joe a call.
Anytime. Yes, Sue, thank you.
Thank you. Thanks so much, Joe. Thanks for having me.